Hi, everyone. I'd like to spend a little bit of time with you now talking about accounting theory. One of the first tasks that was given to the Financial Accounting Standards Board when they were placed in charge of developing accounting standards was the task of developing a set of theoretical principles that would serve as the underpinning for all of the standards that would be later developed by the Financial Accounting Standards Board. And to do that, the first thing they decided they needed to do was to think about who the user was. Remember that we're in business to meet the needs of financial statement users. And what they discovered is that the users of financial accounting information is an extremely broad set of folks. We know that the owners of businesses are keenly interested in how successful their businesses are. We know the creditors are keenly interested in knowing whether they're going to be repaid. We know that government agencies receive reports from companies and use financial reports often as critical information. We know that there are more special agent accountants in the FBI than there are special agents of any other variety. That's probably a comment on white-collar crime and the task of the FBI. The FAA uses information off financial statements and supplementary data to learn how companies are maintaining aircraft and whether they are spending what it would appear they should. Financial analysts make their living out of analyzing our financial reports and providing information to their clients or the companies they work for. And you folks in management, you're pretty keenly interested in financial results because often bonuses and indeed job security is a function of that level of performance. Employees want to know that they're going to have jobs. Labor unions, pretty keenly interested in the success of a company, knowing whether they can press for additional benefits and raises and that sort of thing. And customers. Customers are big users of financial reports. We want to make sure that we're doing business with companies that can service our products, and we want to make sure that they're going to be around long enough to meet their warranty obligations. So what we've concluded really is that we've got an array of diverse users of financial information. And in a complex economic world, we ask the questions, what can we do to best communicate relevant economic information to all of these different people and users? We've concluded that we needed to standardize financial report formats, that when you saw an income statement, that income statement needed to look about the same from year to year and from company to company so that we could compare our results from year to year and from company to company. And so as users, we would be able to understand what's in a financial report. The second thing that we decided we needed to do was to fairly tightly define the words that we use in those financial reports. We want them to communicate so that the word sales at the top of an income statement ought to mean about the same thing this year that it meant last year, and it should mean about the same thing that it does in our reports as it does in another company's reports. The third thing we decided we needed to do was to constrain the measurement rules to a minimum acceptable set of rules. And ultimately, we would hope that we could reduce national differences so that financial reports would be more broadly communicative to people throughout the world. Now, to do that, the Financial Accounting Standards Board first tried to identify the basic theory of accounting, some basic assumptions or basic concepts that would direct us in preparing financial statements and in auditing financial statements and help the user understand what's happening. And so they started publishing statements of financial accounting concepts, and they published 6 of these. And what they did in the context of those statements was develop these fundamental theoretical ideas. So let's walk through them. The first is the concept of a monetary unit. The concept of a monetary unit essentially tells us that only events that can be measurable in money or money's worth are recognized in accounting records. Now, that means that we will not capture all of the resources that a business may have that has value to the business. There's no way around it. We can't value ideas, and we can't value people. And people and their ideas are enormously important resources in a business. The concept of a monetary unit tells us that we will only capture in our accounting records those things that can be measured in money or money's worth. We will capture costs related to the development of ideas, and we'll capture costs that are associated with people. But we won't be able to capture fully all of the resources of any business unit because of this principle. And the idea essentially is one that you need to understand as a limiting factor in the information content of financial statements. Now, the second principle that we'll talk about, or concept, is the concept that we call the entity concept. And the entity concept was an effort on the part of the Financial Accounting Standards Board to define carefully who we are accounting for. If we have two separate businesses and we have one business whose financial report includes just those resources and obligations that are associated with the business, and we have another business whose financial report includes not only the resources and obligations of the business, but also includes the resources of the investors, then we have two sets of financial records that can't be compared to each other. That, we concluded, was a significant problem. And so we are told that an organization is viewed, the organization we are accounting for is viewed as a unit that's separate and apart from its owners and from other firms. Now, the one place where that simple statement, which seems to imply that the legal structure, the business, the corporation, is what we account for, begins to break down a little bit, is in the case of a parent corporation and a group of subsidiaries that it may own. In that instance, the Financial Accounting Standards Board concluded that the entity isn't the legal entity, the parent. The entity in that case is indeed the entire group of controlled companies. Only in reporting the entire group of controlled companies are we going to meaningfully communicate information about this business. And so we present consolidated financial statements that include many legal corporations. The third requirement of the third concept is the concept of objectivity. And this is a desired goal of all financial accounting, that it be objective. And that meant that it should be verifiable by an independent party, for example, an auditor. That means it needs to be evidence-based. And secondly, that our financial reporting and financial recording should be free of bias. Now, we know what bias is in general, but in an accounting kind of a context, what is bias? Well, bias would be entered into an accounting system if we decided that certain activities were good activities, for example, and that because they were good activities, we would treat them differently than other very similar activities. And a good example of that would be a company that puts scrubbers on top of its smokestacks. If a company puts scrubbers on top of its smokestacks, we know that a scrubber is just a piece of equipment and that we would normally depreciate equipment. Now, when we depreciate equipment, we recognize an expense that has the effect of reducing earnings. And so bias would be entered into this accounting if we were to decide that this activity was so good that we wouldn't harm the earnings of this company because it had done something that we, in our judgment today, perceive as being very good. Well, That's bias. And the Financial Accounting Standards Board concluded that we would not permit bias to be entered into our accounting records, so that we will require that scrubbers on smokestacks be depreciated and therefore reduce the earnings of the firm just like all other physical assets with a limited useful life. We don't want bias. We want to be able to compare company to company and year to year without changing notions of what is good and what isn't good, impacting that reporting. Okay. Another very important concept is the concept of a fiscal period. We are going to assume that it is meaningful to divide the life of an enterprise into artificial fiscal periods. We know that we require quarterly financial reports to be filed for publicly traded companies with the SEC, and we know that we require an annual audited financial report to be filed with the SEC. And we've got to assume that that's meaningful information. The alternative probably is to decide that you wait for the entity to die, let all the dust settle, and then very accurately you're in a position to measure the things that have happened and the results. And the problem, of course, is that corporations live for an awfully long time. The Chesapeake and Northern Railroad was incorporated in the United States in 1823, and it's still the Chesapeake and Northern Railroad. And so we would still be waiting for our first report if we don't believe that the fiscal period concept has meaning. Now, the next basic assumption or concept that we have to deal with is the going concern concept. And that's the assumption that this entity will survive beyond the current period long enough to realize its assets and meet its obligations. It's really only by making this assumption that depreciating useful lived property over 10 or 15 years makes any sense. I mean, if we have property that has a life of 10 or 15 years and we're in such financial straits that it's unlikely we'll survive the year, then folks, depreciating an asset over 15 years in that circumstance makes absolutely no sense. And much of the remainder of the valuations that we use in our financial report doesn't make any sense either. If we really think the business is not going to survive, then under those circumstances, what we need to do is to value all of the assets and obligations at their fair market value. So, getting management to decide that this is not a going concern is almost impossible. So what typically happens is that management prepares these financial statements, and it's up to the auditor to make the judgment. Management puts forth its financial statements, and the auditors express an opinion. And if the going concern concept isn't real, can't be made, that assumption, then under those circumstances, the auditor will issue an adverse opinion. And that opinion will simply say that the accompanying financial statements don't present fairly the position and results of operations of the firm because this is not a going concern. It's a real problem in the life of a business. Now, the stable dollar concept is the next idea that the Financial Accounting Standards Board talked about. And what they said is that for U.S. purposes, we are going to assume that the value of money reflects constant purchasing power across periods. That is to say, we are not going to account for inflation in this country. Now, in the United States, we have never had serious hyperinflation in modern times, and that's terrific. In countries that have had this problem, we know that they do account for inflation. Mexico has a very sophisticated set of rules that are designed to adjust its financial reports for the impact of inflation, realizing that inflation has been a greater concern in Mexico than it has been in the United States. So we abide by the stable dollar concept. We don't account for inflation. Now, one of the most important basic concepts in financial accounting is the historical cost concept. And it's pretty simple. It says that the acquisition of goods and services by a business is initially entered in the accounting records at cost. So whatever it costs to acquire that property, that's the number you use. The amount represents the fair market value of the property at that point in time as a result of having been negotiated. And it's definite, and it provides the auditor with a number that's verifiable. We know that where historical cost remains the valuation principle, that means that we could get pretty far from current fair market value of assets. And so we're going to see that although we start with cost as the valuation principle, in many instances we will adjust to either fair market value or lower of cost or market or some other valuation technique, depending on the nature of the asset. And we'll be talking about that a great deal over the next few weeks. The Financial Accounting Standards Board also developed for us a set of revenue or financial measurement principles. And the first of these is the revenue recognition principle. They wanted to be clear in good accounting theory what revenue is and when it could be recognized. And they told us that revenue should be recognized when that revenue meets all of these criteria: earned, realized or realizable, and measurable. That if you fail to meet one of these criteria, then revenue should not be recognized. Now, with that, they also developed the concept of a matching principle. And the matching principle is an enormously important principle in financial accounting. It tells us that good performance measurement in the income statement requires that all costs incurred to earn revenue be matched with that revenue in the same period. And that means that we want the income statement to show the revenues that meet the requirements of the revenue recognition principle, and we want it to show all of the expenses, all of the costs that we had to incur to earn that revenue. If we recognize revenues in period one and then trailing costs and expenses in the following year, then we will have overstated net income in year one, and we're going to likely wind up understating income in net two. So we will go to great lengths to capture all costs, match them with those revenues. And finally, the FASB gave us these three financial measurement principles: consistency, materiality, and conservatism. And consistency essentially tells us that methods should be continuously employed across periods. That means that if you decide you're going to use this accounting method, you use it this year, you use it next year, and you use it the year after, hopefully. Now, the principle doesn't say that you can never change, but the principle does tell us that our goal is not to change. And we know from practice, and we'll talk about this later in the course, we know from practice that when we change, we scream and holler and we make sure that every financial statement user knows that we're counting the beans differently this year from last. Materiality is a basic idea. Materiality tells us that rigorous adherence to accounting standards isn't necessary for really inconsequential items. What this standard essentially tells us is that if you buy a trash can to go in an officer's office, you don't need to set it up as an asset and depreciate it over a 5-year life because it only cost $100 and you could steal the darn thing and it really wouldn't change the view of the financial statement user about the firm. It also gives us some guidance about supplementary disclosures that we need to make. We make them if they are perceived as being material. That is, that they impact the decision that a financial statement user might make. And the last is the concept of conservatism. You know that accountants are very conservative people. And this principle essentially tells us that if we've got uncertainty about method selection, that is to say we've got two methods and they're sort of perceived as being equally appropriate, that we should select the method that generates the lowest total assets and the lowest total income. Okay, those are the basic theoretical underpinnings of financial accounting, and I think an understanding of them is important as we move into our study. I think that's enough. I look forward to hearing from you all.